Most people are aware of the fact that when you sell a long-term investment, such as real estate or stocks, you have to pay taxes. And these taxes don't usually come cheap. Currently, capital gains tax is 15%, and California has its own capital gains tax of 9.3%. To put this in perspective, if you bought a property for $500,000 and years down the line you sell the same property for $1 million, on that $500,000 profit you have to pay $121,500. Plus your cost recovery recapture. That's a huge chunk of cash. But did you know there's a way you can defer that and not even have to pay a single penny? It's called a 1031 tax deferred exchange, or 1031 exchange for short. A 1031 exchange is when you sell your property and buy another like-kind property within a certain time frame and follow specific rules. Now you have to note, this is a tax deferred investment strategy. What that means is that you will just keep rolling over what you owe in taxes to some future date. If you ever decide to completely abandon investing in real estate altogether, you're going to have to pay it all back. The idea though is to continuously roll it over indefinitely until you pass away. Now that we have all that explained, let's get to how a 1031 exchange works, shall we? Let's say you bought a property 10 years ago for $1 million, and today you can sell the exact same property for $2 million. The first step that needs to be taken when doing a 1031 exchange is the process of finding a good qualified intermediary, or a QI. QI is a company that will be the middleman throughout the entire 1031 exchange process. My first tip on this: do not shop around for the cheapest QI. Find a reliable company that has been doing this for years and pick them, even if it costs a little bit extra. This is not something you want to bargain shop for. Once you find the qualified intermediary, you need to inform them of your plans and that you're in escrow with the property. Now that everyone is in the know, here's where it gets a little tricky. There are two key time frames you have to keep track of with a 1031 exchange. From the date you sell your property, you have a 45-day time period to identify a new property or properties. The second is that you have 180 days to completely close on the new property you identified, or if you identified multiple ones. Again, this is from the start date that you sell your property. One thing that must be made clear up front is that these dates are non-negotiable. This means that if you can't identify a property within 45 days, the 1031 exchange is dead and taxes are automatically due when you file your tax return. If you can't close because of financing issues with that 180-day timeline, again, the 1031 exchange isn't valid. With that being said, let's get into some of the details. First, the 45-day time period. Within this 45-day time period, you can choose up to 3 different options. The first and most common option is the 3 property rule. The rule is that you can identify a total of 3 properties at any price. Most investors use this option because once they sell their property, they upgrade to an even larger one. However, once in a while, investors want to sell one property and buy multiple smaller properties. This is where the second option comes in, or the 200% rule. The second option is that you can identify an unlimited amount of properties, but they can total no more than 200% of what you just sold your property for. In our example, we sold our property for $2 million. We can choose as many properties as we want, so long as their total value doesn't go above $4 million. The third option, which is sometimes referred to as the 95% closing rule, can be a bit tricky. It's similar to the 200% rule, where you can pick as many properties as you want, with one major difference: there's no price limit. You can pick 4, 10, or even 20 properties totaling an infinite amount of value. The catch is, you must close on at least 95% of them. This is usually best left to the super savvy investor who is buying everything all cash. Once you get the identification rules down, the 180-day closing period is fairly straightforward. So now that you know the timeline rules, how does it all work? The way it works is just like a regular sale, but with a qualified intermediary acting as the go-through person. Once the seller has their money in escrow and everyone has signed their paperwork, 2 transactions will take place simultaneously. Instead of selling directly to the seller, you will sell to the QI who holds title. The QI will now sell your old property to the new buyer immediately. The funds from the buyer are then given to the QI to hold. This qualified intermediary acts as your trusted holder for your funds during the 1031 exchange time period. Throughout the process, you are not allowed to touch any funds. If you decide to pull any funds out, it's considered boot and will become taxable the second it leaves the QI's control. Now that we've gone over all the basic rules of a 1031 tax deferred exchange, let's get into some of the more common questions. By far the most common question I get is in regards to the like-kind statement. If someone sells an apartment, do they have to buy another apartment or can they buy an industrial warehouse? The answer is yes. Like-kind means real estate, period. If you sell real estate, be an apartment complex, an office space, or a piece of raw land, you can buy any other real estate. You can sell a piece of land and buy a shopping center. You can sell your industrial warehouse and buy an apartment complex. You can sell your investment home and buy a fourplex. Speaking of homes, I'll touch on the second most common question I get. Can I 1031 exchange my primary residence? Well, you don't need to. In section 1034 of the Internal Revenue Code, you can sell your primary residence and you don't have to pay any taxes for up to $250,000 if you're single or for up to $500,000 if you're married. So it kind of makes a 1031 exempt. Finally, is it possible to buy a property first and then sell my property with a 1031 exchange? The answer is yes, but this is called a reverse exchange. It's a more expensive and riskier version of the regular 1031 exchange, primarily because you must find a buyer who will close on your property within 180 days after buying your new property. The same role with the QI occurs. You sell the QI your property after letting them know in advance what your plan is, then they sell the property to the new buyer. When it comes to the value of the new property or properties, the basic point is this. You have to put in equal or more money and buy equal or larger valued property. The loan amount is completely irrelevant so long as the two amounts are satisfied. Remember, 1031 exchanges might not be the best option for every single person, but it's usually the most preferred option for most investors. If you're looking to avoid paying capital gains tax, the 1031 exchange is by far the most common financial technique. Now that's good to know.